Hello, everyone. How are you doing today? All right. Thank you so much. All right. Well, my name is Danielle, and today I'm going to be going through trading opportunities surrounding earnings season. We're also going to be talking a little bit about the state of the market this quarter in particular. But a lot of the information that I have put together for you here today is really covering opportunities that I use quarter over quarter that you can use, rinse and repeat. Obviously, every quarter the situation is going to be a little bit different and the focus is going to shift a little bit here and there. But overall, the strategies and the setups should remain somewhat consistent. So before I get started, I just want to introduce myself. My name is Danielle Shea. I'm the Vice President of Options at Simpler Trading. I am a trader. I'm an author. My book is going to be coming out next year. I'm also a pretty frequent commentator on CNBC and Fox Business, especially. Really just focusing on stock markets, overall long-term macro picture, options trading, and investments. So for me personally, I'm here because I love sharing what I do. And I share it because it's changed my life. So I love to trade, I love to invest, and I also really like teaching. I did used to be an elementary school teacher. I'm actually doing a little bit of elementary school teaching right now with my third grade son. But primarily you can find me here at Simpler Trading teaching about the stock market. So as far as my trading style is concerned, primarily I focus on directional trend following setups, and I really like to focus on relative strength. I also do a lot of trading that is seasonal in nature, so specifically focused around earnings season, and that's what we're going to be talking about here today. So throughout this presentation, these are the topics that I'm going to be covering. I'm going to be talking about earnings and their impact on the market, why that matters. We're going to be talking about the patterns and statistics to watch. We're also going to be talking about setups and timing those setups. And the reason for that is so that we can trade earnings season. Then we're also going to be just, intermixed, talking a little bit about this earnings season in particular and what it looks like in a bear market. So let's go ahead and get started. So I just wanted to start off by talking all about earnings, an introduction to how and why behind earnings analysis, because I think a lot of the time, newer folks who are newer to the options market get a little bit put off by earnings because it can be so volatile. But I really wanted to just take a minute and explain, why it's important and the key facets that you really need to look at when an earnings season comes about. So it could seem like a lot, but it's really simpler than you think. These are the main areas that you just want to focus on looking at. The earnings report is probably the most critical factor. And of course, those are going to come around quarterly. This is where we get reports from companies as it relates to their EPS numbers, their sales, their income, their balance sheets overall. It's really not important to, go through and read an entire balance sheet as far as, a corporate earnings report is concerned. For traders, the main thing that you really just need to be focused on is, why is the earnings report happening? What is that telling us? And how can it give us specific patterns that we can actually trade? It's really not necessary to dive into, pages and pages of numbers and math when you have your patterns and statistics that you can use along with your calendar that tells you when these opportunities are coming up. So, just to start at the very basics, what are earnings? Earnings are going to be the after-tax net income, and it is the bottom line. So, for me personally, I do think it's one of the most important numbers that you can study as it relates to a company. But as traders, what you'll see and what you'll know is that sometimes, earnings will be bad, and then the company's stock price will skyrocket, or earnings will be good and the company's stock price will fall. So it's not the number that's the end all be all. It's really just the pattern as it relates to that specific company and then the season in general. So earnings are going to be the profit that a company is going to produce over a specific period that represent the direct link to the company's performance. They are going to be the main determinant of a company's share price. And, people who are only focused on fundamentals, that's really the only thing that they focus on. But as you'll see throughout the presentation, I also focus on consumer sentiment and then also technicals as well. So let's talk about why it matters. It matters more than normal right now, especially because of the current bear market. Okay, so earnings is always something that I've looked at, but in the past, especially when we were in a really strong bull market, what earnings meant was it was just another reason for stock prices to go higher. What earnings are doing and what they mean right now is you're really able to see the good, the bad, and the ugly. So previously, before, we just had such a strong stock market, and even companies that weren't actually performing well on a fundamental basis, they were skyrocketing higher, and fundamentalists would say that makes no sense, but it didn't matter because we could still trade them to the long side. Well, now it matters even more because we're in a bear market, and that's really when you have to separate the good from the bad from the ugly, because it's not a situation where just everything is going higher. So what we're doing and what we're using when we're looking at earnings season analysis is we really want to look at how the company has fared in the past, before, during, and after earnings, and then use those patterns to give you some trading setups. So here's an example of Teladoc. This is one that I've shorted a couple different times this year, and this is on my earnings hot zone. This is the earnings analysis tool that I use. And basically what it does is it's going to give you data as it relates to whatever time frame you want to look at. On this chart, this was looking at about 2 years of data. You can see it right here, 8 quarters analyzed. And what I'm looking at is how many times the company has beat earnings. They've only beat earnings 3 times. They've missed estimates 5 times. And do you notice a pattern? Here's earnings. You see how every single earnings report, this stock has dropped like a rock, sometimes more than others. We had, 43% time, 18% time. This is 1.8% time. But the moral of the story is that there are going to be companies where there's no logical pattern. Sometimes it goes up, sometimes it goes down. That's not a setup. That's not what we're looking for. We're looking for companies that show distinct patterns that appear, quarter over quarter. And this is an example of one of them where, it's a company that just keeps trading lower every time it reports earnings. So also keep in mind that, as an investor too, investors are going to look at earnings through a different lens than traders do. If you're looking at earnings as a method to purchase stocks on a long-term basis, it's not going to matter as much if the stock maybe falls slightly after earnings or something like that. In that case, you would actually might want to use earnings to buy the stock. But as traders, we're looking for the shorter term patterns. So as far as looking at the difference between fundamental and technical analysis, I think it's important to use both of them. When I first got into trading, I only used technicals. And after a couple of years, I got more into the fundamental side, especially as I started doing a lot more media. But I do think it's important to use a little bit of both, and that's what earnings analysis is, because you're looking at both the technical patterns going into earnings, and then you're also looking at, how the actual numbers are impacting the stock. So, for example, if you were just a fundamental analyst, and this is where a lot of the times, people on TV like get a lot of heat because they'll have fundamental analysts go on and they'll say, oh, this company's so strong in the balance sheet and this and that, and then it'll drop like 10% on earnings, right? But that's why I like to combine both of them. So, if you were looking at it just from a fundamental perspective, like something like Microsoft, you can say, hey, the company's growing on a quarterly and year over basis. They have beat earnings estimates every quarter. They're leading in the industry. The macro factors are supporting the growth and trajectory. That would be a bullish take just from a fundamental perspective. But that can be true, while it can also be true that the technicals are totally broken down and it's sitting here, at the lows of the year. So if I'm looking at it from, a technical perspective, that would really just be focusing on the overall technical pattern. But for me personally, combining both of them is what makes the most sense, because it can be true that Microsoft, they pretty much always beat earnings. They beat earnings 7 out of the last 8 quarters. Out of the last 8 quarters, they've traded higher 6 out of 8 quarters. Even in the midst of the bear market, they've traded higher post earnings, but it can still be true that they're down at the lows on the year, in a bear market. So that has to come into consideration as well. So what's happening and why is this so important is that, earnings are just giving you like a snapshot over the last 90 days. And with everything that's going on in the world right now, the inflation that we have, the bear market, the loss of wealth, the fact that consumer spending is going down, the fact that commodity prices have been elevated for quite a while, the fact that the pandemic has given us ups and downs, all of those things are going to impact companies and how much money they make, and therefore the earnings that they report. And because we're in such a volatile market situation right now, the market is very, very jittery, and the market is at a spot where it is not going to tolerate bad news very well due to the fact that we're going into an earnings season at the lows on the year. So, on one hand, when you're looking at earnings, it's giving you a snapshot of people's behavior and where they spend money, okay? Because if Walmart's going to come out and say, hey, guess what? People aren't buying any of our expensive products anymore. They're only coming for our value groceries. Like, that is going to give us a view into how people are shifting their behavior, either because of seasonality, because of, disaster, the pandemic, because maybe their interests have changed because now they're working at home, or maybe they're going back to work, or, whatever. So that's why, I personally think that being in tuned to what's going on during earnings season is going to make you a better trader and a better investor overall. Even if you have zero interest in trading an actual earnings report, just keeping tabs on what is being said about these different corporations is going to give you so much more knowledge that will help you in trading and in investing, because the conference calls that they have after earnings reports, they give you so many gems as far as, what is impacting their bottom lines. And so I just think it's highly important, as a trader, to know how to read into that and pay attention to it. And one of the reasons is because it will give you a really good view as far as sentiment is concerned. Because fundamentals, they can take a while to change. But when, executives come out and give you the details as far as what is impacting their bottom line, that is something that can tell you pretty quickly how sentiment has changed among consumers in the market and how that can impact your overall investments. So here's a good example of a chart that really changed. I mean, for a while, energy stocks were they were not really going anywhere. They're kind of, creeping higher and going a little higher, not doing too much. Then all of a sudden, last fall, we started to see like oil prices spiking. And then all of a sudden, energy stocks were like the next best thing since sliced bread. So a lot of the times too, if you go back and you're looking at, earnings, you can see how maybe a company had kind of flat earnings and it wasn't really doing too much. And then all of a sudden they started making more money. They started rallying going into earnings because people were excited about their earnings reports. And then also, because this one's commodity based, when crude rolled over, Chevron rolled over too. So you can always look for, shifts when it comes to earnings. For me personally, I like ones that are a little bit more consistent, but that is another topic in another chapter. So, for example, the pandemic has changed, a lot of consumer behavior, which has impacted corporate earnings, and then therefore which stocks are the strongest in the market. In options trading, you always want to be trading, the heroes or the zeros. You don't really want to be trading the stocks that are just not really doing anything, not really growing. They're not going to provide you that much movement. But anytime anything is super hot, that can give you a great focus for upside trades. And anytime there's something getting clobbered, like retail is right now, that can give you a great opportunity for downside trades. So that's another good reason to pay attention to consumer sentiment. So consumer sentiment, when I say that you should pay attention to consumer sentiment, that just really encompasses all of these different factors like, what are consumers looking at? Are they confident? Like, do they feel good in the economy? Are they panicked about a recession? Are they spending? What kind of insight can we get from news and earnings reports? So the sentiment is really the right now. And then the technicals are going to reflect what has been going on, whereas the fundamentals are going to be the actual, numbers. So it's all of this that really comes together that equals, trading and investing strategy. So next, we are going to be talking about patterns and statistics. So using patterns to identify trading ideas. So now that we went through kind of the background of why it's important, let's get into the setups. So trading setup is highly critical for traders. A setup is going to be the moment in time where you have identified the high probability pattern that will likely end in a specific resolution. And around earnings, there's definitely going to be multiple different patterns that have to do with this seasonality. So, like I said, the fundamental technical consumer sentiment combination is great because companies report earnings quarterly. We never have any idea when there's going to be a war starting or, any kind of major political shift or change or a new law that's coming out. There's all kinds of things that can make a catalyst happen in the stock market that seem to come out of nowhere and that you can't predict. What you can always rely on is the fact that earnings are going to come around every single quarter. They're going to be on the calendar, and there's no it's not like, oh, this quarter it's not happening. Nothing like that. So that's why, as a trader, being able to identify the opportunity in it can be really beneficial because you can use something that is going to happen to identify patterns. So here's a couple different earnings setups that I like to use as a swing trader. And generally what I'm looking for is going to be the move going into an earnings report. So right here today, when I'm doing this presentation, It is September 28th. Okay. The core of earnings season is really going to be mid to late October for this quarter, right? So what that means is that we are approaching and we're in this time frame for a lot of different companies. So what I like to call that is going to be the hot zone, which is why I named the tool that I made the hot zone. Because this time frame is when you can really look for moves that stocks make going into earnings. The run into earnings is going to be a bullish move, and earnings destruction is going to be a bearish move. So because of where we're at on the calendar right now, that is starting right here, right now, this week. The next opportunity is going to be still a swing trade, but really just overnight, which is going to be trading the actual earnings report. And then the third opportunity after that is going to be trading post-earnings trades. This is going to be looking at a move, maybe 2 to 10 days post-earnings after there's a big explosive move. So here's a couple different examples of these patterns when you're looking at Zoom. And I just zoomed in here to the last 4 quarters, especially so that you could see. But on average, over the course of the last 8 quarters, we have seen Zoom trade lower in the hot zone by about 4%. So the hot zone on these charts shows up 21 bars prior to earnings. And basically it just notifies you that, hey, guess what? You're getting within a range where earnings is coming up and we can look for a directional move. So you don't need the chart to do it. I did it for a long time without the chart and I just, counted. I just think it's helpful. So when you're looking at Zoom, this is one that has a pattern of falling going into earnings. So what that means is that every time earnings comes around, it's like, hey, guess what? Zoom is getting up. It's close to entering the hot zone. This is a time where we want to be ready to look for a directional trade to the downside because we have our patterns, we have our statistics, and then the fundamentals are also largely backing this one up because this was a major COVID stock that rallied and has since, been rolling over and dying. So here's another example of a pre-earnings move that's typically a bullish move. Now, in the bear market, obviously, it's pretty dicey looking for a move higher going into earnings. But even though Apple has experienced 2 pretty big downfalls going into earnings itself, overall, statistically, over the last 8 quarters, it's still up about 3% going into earnings. So it's definitely dicey here because of the technicals and because of the way that they've broken down. But you do know that this is a ticker that normally trades higher going into earnings. So it's one to watch in case the market starts really trading higher here. The next one is going to be earnings moves. So one thing that you can do is you can trade overnight trades on earnings. This is going to be where you're actually making a bet on how the earnings report is going to go. Typically, making a bet on how the report itself is going to go is going to be the more aggressive option, just because you never know. Could be some, complete move out of left field where they say that their CEO has gotten arrested, and you never know. There can be weird things as it relates to news. But overall, what you can do is you can still look at statistics and you can still say, okay, well, Adobe, for example, has fallen the last 5 quarters in a row on earnings. So maybe when the earnings report comes up, shorting it is something that's statistically backed. Next is going to be post-earnings moves. So this is one that I used on CNBC last quarter. There are stocks that statistically have moves either higher or lower after earnings on a regular basis. Now, Microsoft is kind of crazy because even in the bear market, even as we've, continued to trade lower, made new lows on the year, Microsoft has still had major gaps higher on earnings, and this shaded green area post earnings just means that in the 8 days after earnings, it was higher than it was on the day that it reported earnings. So that shows that on average, Microsoft usually trades higher by 4.37% or about $10 equivalency to the current pricing. So that can also give you another opportunity as an options trader too, looking for those earnings moves after the fact. That way, if you don't want to trade the actual report and you would rather wait and say, hey, you know what, I don't want to trade the actual report, there could be something crazy there. Let's instead just go ahead and trade a potential post-earnings move. Let me identify tickers that statistically move in one direction or another. That is a safer move that you can take part in. So when it relates to earnings opportunities, you have about 13 weeks in the quarter, and then you have various trading setups that are going to take advantage of the moves prior, during, and after earnings. The meat of earnings season, it's really around weeks 4 to 6. That's where most of the volatility lies. So coming up, that's going to be, like I said, mid-October to the end of October. So usually when I'm trying to quantify when that exactly is, what I'm going to do is I'm going to look at Tesla. I'm going to look at Netflix. Netflix is usually the first major stock to report earnings. How did I do that? Spelled it wrong. Silly me. So I'm going to look at Netflix. I'm going to look at Tesla. The banks are important. They do move the market, but not as much as Netflix and Tesla. Then I'm also going to be looking at Microsoft. I'm going to be looking at Google. I'm going to be looking at Apple. So basically the major, tech stocks, FANG stocks. So as of right now, that's going to put us between October 15th and about October 30th, where we're going to see quite a bit of volatility. So there's a couple different resources that I use, the earnings calendar, EPS, revenue numbers, implied volatility, market maker moves, support and resistance zones, and previous earnings history. Having a calendar is really important when you start looking for these moves going into earnings. Another thing that you want to do is just have a source for checking the EPS and revenue numbers. I personally find it really easy to just look on CNBC because they usually make really in-depth articles directly after earnings are announced. You can also check in your trading platform. So within Thinkorswim, you can look at, what was the actual earnings estimate and then what did they actually report. So Uber, for example, the earnings estimate was a loss of $0.25 per share, but they actually lost $1.33 per share. So I'm not necessarily focusing on the number. Like, I don't really care if it's $1 or $5 or whatever. What I care about is what was the actual number as it relates to what was expected. And then I'm also looking at how has it changed throughout history. Is earnings improving? Is it trading lower? Is it going down? All of those kind of things. So when you are looking at the EPS numbers, that's the main thing that I'm going to take into account. As it relates to the market this year, it's been a little bit different just because I normally would prefer to look at about 8 to 12 quarters of data, but it's also not really helpful to compare two completely different market scenarios. So for example, take Peloton, okay? Peloton was like the hottest stock of 2020. And, now it's the biggest turd. So it's not really helpful to look at Peloton over the span of 8 to 12 quarters and say, oh, well, on average, it goes higher into earnings because the bear market broke Peloton. So when you're looking at an individual stock and analyzing it, especially just in the bear market, if something has had a major shift, just looking at the last year is going to give you much better data than looking at, the last 3 years. So here's Zoom again, but stretched out to look at a few more quarters. This was really when it broke. Previously, it used to have a great run into earnings, and now it's just, complete downtrend. So using the more recent data is going to be a lot more important. Here's another one that had a major shift. So the housing market was incredibly strong. Commodity prices got way too high. We saw the housing market peak. And, previously DHI was one that we would look at to the upside, but now it's one that I will look at to the downside going into earnings. So as far as, research is concerned, I definitely do a large amount of research on, CNBC, Bloomberg, Wall Street Journal. Mainly what I'm looking for is I'm looking for like an overview of what the executives of the company have noted. I'm not necessarily, watching the media and saying, oh, like this analyst said he's bullish on this stock because, even though I do take it into account slightly, just because I like listening to different opinions. The main thing that I'm looking for is the actual facts and the actual data as far as what is coming out of the company. And that's why I think that media resources can be very beneficial for that reason, especially as it relates to earnings, because, they have people behind the scenes that just sit there and read the entire earnings report and pick out all the important parts. And so if you look at a summary, it's going to save you a lot of time. And time is very important. Is this being recorded? Yes, it is being recorded, and I will post a recording on I'll definitely post it on Twitter later. We can post it in here as well, but it is being recorded. So most of the technical and fundamental research that I do is coming from the earnings hot zone. So if you want to learn more about the earnings hot zone, you can go to this link. So I didn't used to have the earnings hot zone. I mean, for a long time, I just looked at the patterns myself on the charts. And that was how I figured it out. The main thing that the earnings hot zone does is it just saves you a lot of time. So, here's a link to learn more about that. All right. So what the earnings hot zone mainly demonstrates is it's going to demonstrate statistical patterns. It'll demonstrate the patterns pre-earnings, over the earnings report, and then post-earnings. So based off of however much data you're looking at, it's going to give you the stats. If you want to look at 12 years of data, you can. But I normally stick to 8 quarters. So it's going to give you these statistics that will tell you on a pre-earnings 21-day time frame, is this normally going up or is it normally going down? Okay, Costco has been, over the last 2 years, trading lower by about 3% on average in the 21-day time frame going into earnings. What about the 8-day average? The 8-day average says that it usually falls about 2% on just the 8-day time frame going into earnings. As you can see, this quarter it had a pretty big fall going into earnings. Then it also gives you the statistics for post earnings. So what is the 8-day average after earnings? Sometimes you're going to find that there's no trend, like it's completely flat after earnings. In that instance, if you do trade neutral strategies, that would be something that would be beneficial. And then this is telling you big moves. How many times have there been big 8-day up moves or big 8-day down moves? and it's pretty mixed. So if it's mixed, it's not giving you a pattern, right? It's just telling you that it's mixed. Then it also gives you the stats for what the actual move was over earnings. And it also calculates the implied volatility as it relates to earnings as well. Then these screens, they pop up with different colors based off of how the move was. They're red if it was down, yellow if it was neutral, green if it was up. So let's go ahead and talk about trading opportunities around earnings and using options to take advantage of earnings. I think that you said that volatility is in higher weeks 4 to 6. Which one is week 1? So week 1 is going to be the week where all of the earnings reports start. So it's going to be a little bit different every quarter. Usually the best way to gauge that is I start off, you can go to Earnings Whispers, and you can just go ahead and go to a calendar. There's going to be like a couple different earnings reports every week. Even when you're not in the core of earnings season, there's going to be some earnings reports. But generally what you do is you just kind of go through the calendar, and you see how on Tuesday, October 4th, there's only one company reporting. Tuesday the 5th or Wednesday the 5th, there's only 4, and those are companies that I've never even heard of those. So you just want to kind of scroll through the calendar and say, okay, when is it getting started here? So October 11th, not much going on. October 12th, well, you have Pepsi there. Okay, October 13th. You have Domino's and Walgreens, but that's not really too much. So let's go to the week of the 17th. Okay, so normally I would say that week 1 is usually the week that the banks are reporting. So in this example, we have the week of October 17th. We have Bank of America, Bank of New York, Charles Schwab. See, after market close, not too much there. 18th. So we have Goldman Sachs, Johnson & Johnson, Netflix. So this is generally what I would consider week 1. So that would be, week set right around October 17th. So you have October 17th, October 24th, October 31st. This time it seems a little bit late, honestly, for when all the major companies are starting to report. So I would actually move that down to say week 2, week 3 this quarter. Because usually when Microsoft and Apple reports is going to be the most volatile, and then the week after that is going to be even more volatile. So Microsoft and Apple, I believe, are going to be on the 26th and the 27th. So we have Ford on that day. And sometimes too, if the earnings reports aren't confirmed this far out, it's not going to show it just yet on here. But Microsoft and Apple are projected to be the week of the 24th. So that is really where I would consider a lot of the volatility to be. But as you can see, they're not listed just quite yet on this chart because they're probably just not confirmed yet. So whenever you're trying to figure out which week is which, just start with the banks. Sometimes they're split, so they'll do, for example, like JP Morgan and Goldman Sachs on a Thursday, and then the rest of them will start on Monday. So you kind of have week 1 starting at the very end of the week, and then week 2 is the next week. It looked like this quarter they were more going to be starting at the beginning of the week. Well placed ad. It's funny, right? If that makes sense. So when you're looking at, trading options around earnings, Apple on Thinkorswim says the 27th. Thinkorswim is usually going to be the most accurate location. You can also, whether it's Thinkorswim or whatever other trading platform you have, You can also usually see on the platform whether it's confirmed or not. It'll say estimated or confirmed. And if it's just estimated, then it just means it could move. So in any case, when you're focusing on trading options around earnings or any other time, you have to have, number one, your method. So in this case, the method is identifying, patterns around earnings. You need to be able to recognize, what are the distinct patterns. In this case, you have the run into earnings, which used to be my favorite strategy in the bull market. In the bull market, it was pretty, relatively easy to identify stocks that were going higher and simply ride them higher going into earnings. But now that we're in the bear market, we've really shifted to more earnings destruction. And the difference is really important because it goes back to the underlying fundamentals and the underlying technicals as well. You have to think about the reason why these patterns occur. So, for example, on a stock that's just trading sideways and going nowhere, it's occurring because they're not demonstrating growth. They're not demonstrating more money. They're just kind of hanging out, doing a whole lot of nothing. Like a lot of dividend players, they aren't high growth stocks. They're not high risk stocks. But people buy them and hold them because they get dividends and they don't have to worry that much. And what that means is that the stock price is just kind of flat, right? Which is fine if that's what you're trying to do as a long-term investment strategy. If you're trying to identify moves going into an earnings report, you have to recognize why someone would buy or sell a stock prior to earnings. When you have a stock that has, bad fundamentals, it has bad technicals, and the consumer sentiment is low, as in people are saying, well, nobody else is going to sign up for Zoom now. People are going back to the office. And, why would we be more interested in Zoom in September of 2022 than we were 2 years ago? When these things are negative, that means that you have a much higher probability of an earnings destruction pattern. And the reason for that is because if the fundamentals aren't looking good, if the technicals are going lower, if people aren't excited about the company, why would anyone want to buy the stock prior to earnings? Well, they wouldn't, right? If anything, they might say, oh man, I hope it doesn't do a teledoc and I'm going to sell shares in this company prior to earnings because I don't want to lose money if it falls 40% overnight. So that's the idea behind earnings destruction. The run into earnings, the idea behind it is that, the fundamentals are strong, the technicals are trading higher, people like the company, the consumer sentiment is good. And so when you have positive sentiment, you have investors that are actually buying the stock prior to earnings, which gives you that bullish pattern. So when you have those patterns, it's at that point that you have to decide what kind of strategy you're going to use. And the strategy is also going to go back to risk reward because, some people might say, hey, you know what? Actually, I don't even want to trade options. I just want to buy and sell stock, which is fine. Some people might say, hey, you know what? I want something that's very low risk. And I don't care if it's low reward because I just want the risk to be low. Some people might say they want a very beneficial risk to reward. Some people might say, hey, you know what? I think this stock is going to do exactly what I'm predicting and I want to put a lot of risk on it, which we don't recommend. But that might be the case. So these are the things that you have to take into consideration. As far as options trading itself is concerned, you really want to take advantage of the unique facets of options and take that into consideration when you're making options trades specifically around earnings. So here's a couple different facts about options. Options lose money via theta decay over time. So if you know this fact, you know that they lose money over time. What's something that you can do to take advantage of that fact? Well, you can sell credit spreads. Okay. You can also buy longer days till expiration options, like don't buy them if they're going to expire today kind of thing. Number 2, the IV rises going into earnings and key events. So if you know ahead of time, here's your earnings report, and we know that, the implied volatility is going to go higher going into earnings, then what's a strategy that you can use to take advantage of that? Well, you certainly don't want to sell options if it's going to be, the IVs going up. You would instead want to be buying options if the implied volatility is going up, because the implied volatility has to do with the price of the premium of the option. So if you know it's going up in earnings, makes it a better time to buy a call or buy a put. Then here's another important factor. Multi-leg option strategies help traders control their risk, maximize reward, and pinpoint specific price targets. So I personally really like using spreads and using butterflies. It does get a little bit trickier around earnings season because of this factor right here. So for example, you can't buy, they'll let you do it, but it probably won't work very well. You shouldn't buy a butterfly in the same week as earnings, nor should you sell a credit spread. And the reason for that is because in those strategies, you want your IV to go down and instead it goes up. So that's no good. So you want to avoid doing that in the earnings series. But you can do it before earnings. You can do it after earnings. You can do it any other series. Just don't do it in the exact same week. If that makes sense. Options are going to move based on the underlying stock price, along with the key additional factors. So, for example, if you go and buy some puts on Zoom and the implied volatility is going up and the stock price is going down, you basically get a double whammy on your puts, because the puts go up in value because of the IV expansion, and the puts are going to go up in value based off of the move in the underlying stock price. The price that options move based on the underlying stock prices changes in implied volatility and how far they are until expiration. So you definitely want to take into consideration the expiration date. Implied volatility is going to move the most in the actual earnings series. So if you're using an earnings strategy like a debit, buying calls or buying puts, then that is going to be a time where you'd want to take advantage of the actual expiration date that's in the same series as earnings. If you are using a strategy where you want that implied volatility to go down, doing something like selling a spread directly before earnings where the implied volatility is going to go down directly after earnings makes sense. Another important facet here is that delta is going to be the critical Greek that helps you select a strike, and you can see how much it'll move based on the change in the underlying stock price. You also really want to take into consideration the intrinsic value and the premium, because when you're looking at, buying or selling an option, knowing how much actual value it has is going to be important. So you can set your options chain to look at, the intrinsic and the extrinsic value. So it'll tell you, how much is the option actually worth versus how much how much of it is premium that is only going to decay over time. When you're trying to buy options, you generally want to have purchased options that have actual intrinsic value. And when you are trying to sell options, you really want to sell the ones that have more extrinsic value, because the extrinsic value is what decays. The intrinsic value is the one that holds steady. So those are some things to check. And the options pricing is also just going to be based on the changes in volatility, and how that and those are going to impact, the premium and the change in price. And volatility is pretty much always going to go up into an earnings report. So if you look at implied volatility on a chart, you can definitely look at it in your options chain, but it's not going to chart it for you in the options chain. When you're looking at implied volatility on a chart, that's how you can see how it goes up and how it peaks over time. There are going to be some times where, like, if the market took a turn for the worst, maybe the implied volatility spiked actually before the earnings report, which is right here. That usually happens when the market just completely rolls over prior to the earnings report. But for the most part, what you're going to see is throughout the course of the quarter, you're going to see the IV gradually increasing. And it usually peaks right around earnings, and then it will fall off after the fact. So you can see on this chart, this is what it looks like on Adobe, where the implied volatility just tanked after the fact. That just means that the extrinsic value of the option just got the value sucked out of it. So if you happen to sell premium on an earnings report, you're in a good situation. If you bought the premium, you're in a bad situation, because the value of the options just got sucked out from underneath you. So you just want to think to yourself, if you can identify patterns on a specific stock, and then you can also know patterns as it relates to options pricing, as in it goes up, then comes down, what kind of option strategies would you use throughout the season? So if we're looking at specific option strategies, you want to pair those strategies with patterns. So for me personally, I like to try to pick, the high probability patterns, and then I like to pick the option strategy with the best risk to reward situation. So the first thing that you want to do is you want to identify a ticker with a pattern. So you can go through the earnings calendar, and you can identify which companies have earnings coming up, and then just look at the charts. Look at the charts and say to yourself, okay, this is when earnings is happening. Does this stock trade higher going into earnings? Does it trade lower going into earnings? Or is it flat? And if you're looking at something and you're like, well, half the time it's up, half the time it's down, that's not a pattern. That just tells you right there that skip that one. You want to be looking for ones that have an actual pattern, because if it doesn't have a pattern, the entire idea is kaput. Is that the same for receiving a credit on a butterfly? So when you're receiving a credit on a butterfly, it's basically a credit spread on steroids. So yes, when you're receiving the credit, you want it to be used in a situation where it's going to be beneficial that the implied volatility is going down. So a lot of the times we will buy unbalanced butterflies on earnings, because the vol crush is what happens on earnings when the volatility goes up and then it goes down afterwards. So if you come in, you buy an unbalanced fly, you're doing a 1, 3, 2. You buy 1, sell 3, buy 2. You're getting a credit, an overall credit. And even though you're buying to open, you're getting your credit. And so you want to be able to use that in a time where the premium is going to be sucked out and the IV is going to be crushed. So over an earnings report is a good time. Doing it 3 weeks before earnings in the same series as earnings where the implied volatility is going up, not a good time. Does that make sense? So after you identify your pattern, then you just want to think about your strategy. So the long calls are generally going to work the best on the run into earnings because you're looking for the implied volatility going up and you're looking for the chart pattern to go up. If you do it on an actual earnings report, that it very rarely works. It can work if there's a crazy explosive move, but there has to be like twice the expected move because you have to have a much bigger move to override the volatility crush. So we usually don't like to use calls or puts on the actual earnings report. Now, the post earnings trade, like in the example of Microsoft I gave, where it usually trades higher by like 5% after earnings, you can use calls for that because the IV crush has already happened and now your calls cost less. So that would be fine. Now, if you're looking for an earnings destruction setup where you think that the stock is going to just roll over and die prior to earnings, you would not want to use long calls. You don't want to use puts, right? So instead, use puts. Now, spreads are great. I love credit spreads. I like them more than I like selling credit spreads more than I like buying calls or puts just because the risk is less. You can get a better risk to reward. You can take advantage of theta decay. But you want to think about when you're doing it. You don't want to have it in the same series as earnings because the credit spread functions in such a way that you want the premium to be going down and you want the implied volatility to be going down. So it's usually not a good plan to do it for the run into earnings unless you do it not in the earnings series. If you start a month in advance and you sell a credit spread like here 2 weeks prior to earnings, and then in that situation it can work, but you just don't want to do it in the earnings series. However, it's a great strategy to use on the actual earnings report. And it's also a great strategy to use post earnings. And that's because on the earnings report, you're looking for that quick IV crush. And on post earnings, a lot of the times you can sell a spread in the opposite direction of the move. So if Microsoft gaps up 5% and you think it's going to go higher, you can sell a put credit spread. If Netflix, gaps down and is rolling over and dying, you can sell a call credit spread because the IV is still a little bit elevated the day after earnings and it'll keep decaying quickly until the expiration series. Days till expiration. Now, butterflies are my personal favorite strategy, which is why it always makes me sad to not be able to use them in the exact earnings series. So, does everybody know what I mean by the exact earnings series? What I mean is that, if Microsoft is reporting on October 26th, maybe, and the options for that week are expiring on October 30th. you don't want to, 3 weeks in advance of Microsoft earnings, you don't want to say, oh, well, I'm going to buy a butterfly that's expiring on October 30th, because that's in the earnings series. Does that make sense? Because what happens is even if Microsoft does go up, the implied volatility also goes up. And in your butterfly, you have a structure where you have buy one. Oops, sorry, that was supposed to be a sell. Sell two, buy one. And in the butterfly, what you want is you want those center strikes to decay. That's how the butterfly matures. But if you buy it in a series where the IV is going up, the center strikes can't decay. And so your butterfly just ends up about flat. And then you say to yourself, well, I was right though. Microsoft did go up and my trade didn't make money. And then you say, well, it's because you put it in the earnings series. You can, however, use it the series before, and you can use it the series after. So usually with my butterflies, that's what I do. I'll place them in the series before or the series after. And then that way I can still, capitalize on the move. I especially like to do it that way if the series before is the monthly expiration series, because that's usually where I like to place my butterflies, is in the monthly series. So, I know it kind of seems like a lot, but you just think about it this way. Like, each strategy builds, right? So, you just start off by using calls and puts. From there, you can move on to debit spreads. From there, you can move on to learning credit spreads. From there, you can learn butterflies. From there, you can learn unbalanced butterflies. Okay, so each strategy, just the knowledge of each one builds on each other, and this is typically the order in which I recommend learning them, because I just think that it makes the most sense. So, you don't have to use all of these various kinds of option strategies to trade earnings. You can literally just trade stock if you want. The reason why options are more beneficial to trade earnings is because you have implied volatility, and you have premium, and you have that intrinsic and extrinsic value, and you have those other things that you can kind of get a double whammy on. But you can still just trade directional moves using stocks as well. So, typically, this is where I always recommend people start, and then over time you can add in the more complex option strategies. So you just think of it this way, identify patterns on a specific stock. The patterns as it relates to options pricing, as in it goes up, comes down. What kind of option strategies can you use? So this is just a summary of kind of what we talked about, the different strategies that I will use throughout earnings season. I'll use the run into earnings. I'll use earnings destruction. I'll trade the report. I will trade post earnings trades, and use a variety of different option strategies on each one. It really just, it just depends on the individual best case usage. So, does anyone have any questions? Thank you. Awesome. Well, the hot zone is on sale right now, so if anybody wants to check that out, you can definitely go to this link below. The hot zone is on sale, 20% off currently, which I think is a pretty sweet discount prior to earnings season, so you can check that out. Am I taking off earnings? So I am currently almost 9 months pregnant, and I am going to be taking maternity leave. I'm not exactly sure when, but I think the baby is set to arrive sometime right around the middle of earnings week, key earnings week, FANG earnings week. So I'm going to be here as long as I can, but I'm gonna be here as long as I can, but I don't know exactly when I'm gonna be here until. So I'm gonna be here through, you know, throughout the majority of October, and I'm gonna be, regularly in my mastery and in the options gold room and everything else. I usually do quite a bit of I usually do quite a bit of content in the mastery, especially during earnings season. But then at the end of October, I'm going to be on maternity leave. So if you're going to sign up for my mastery, this is currently what we're doing with the mastery. I mean, I'm definitely going to be here all month. And then once I do go on maternity leave, anyone who is in my mastery is going to get a free class of mine. They're also going to get free access to Sam's weekly report, and they're also going to get free access to Allison's mastery. So those are the three things that you would get if you are in the mastery when I go on maternity leave. And from there, we'll see how it goes. So you definitely can still sign up for the mastery if you want. Just know that, at the end of the month, I'm going to be heading on maternity leave, and then it would transfer over to getting access to Allison and Sam. And if you already have access to one of their products, you can request a different one. So you can, get whoever else's mastery that you want. So yes, I'm definitely going to be coming back. I'm not, really sure how everything is going to go, obviously, but I will definitely be back when I can. So it's been a long time for me. My son is 9, so it's been a long time since I've had a newborn in my midst. So it's certainly going to be a new experience. Thank you. Yeah, so normally, throughout earnings season, we'd be doing a lot of, I write a lot of additional content and stuff like that, watch lists and everything else, but gotta pop back in with the baby pics, yes. Yeah, so if you do want to check out the mastery, just go to, let's see, what is the page? I can give it to you. So there's a trial link if you want to check it out. simplertrading.com/join/profits-trial. Yeah. So other than that, I think that's about all I had for you, unless you had some other questions. You can also find me at on my newsletter. So for my maternity leave, we are going to have Mary Ellen, Sam, Allison, and Cody. They're going to be trading off, posting articles on 5-Star Trader. The best place you can probably find me is going to be online. So I don't know. I'll see how it goes, but usually I post pretty actively on Twitter. I haven't been as active lately, but following me on Twitter is generally a pretty good spot to get some information there. Information, updates, baby pics. I'll probably give Henry or Sam or something a baby pic they can share. Awesome. Well, if anybody has any more questions, feel free to, you can email me. You can send me a message on Twitter. My email is Danielle at Simpler Trading. See if I can write neatly with my mouse. .com. And yeah, let me know if you have any questions. Great. It will give me time to go through some of your courses. Good luck, and I will have questions for you when I get back. Awesome. Most excellent. Yeah, I think it's been a little bit back and forth with my doctor about, oh, it's going to be this week. Oh, it's going to be that week. So I think I'm driving everyone at the company crazy as well as myself. But definitely once we have a little bit of more concrete dates, everyone in the mastery will be getting, information as far as where we go from here and all that kind of stuff. So that should be coming soon. But I hope everyone has a great rest of your day. And I hope that this has been a good use of your time and helpful to you. And I will see you during the next session, wherever that may be. I will talk to you soon. Bye.